Hello and welcome to another episode of Selling Life Annuities. I'm Steve Allison, Annuity Specialist here at Gordon Marketing. And with me today, we got friend and colleague Tim Luby, our National Sales Director for Annuities. And today we wanted to discuss, the uniqueness of qualified money and, different opportunities you have with annuities. So just to get right into it, Tim, I know there's a lot of nuances and different things about qualified money. Can we just jump in first and kind of explain what that is?
Yeah, it's a great point. Great question. Not everybody knows. We work in this every day, so we take for granted what qualified money is. But many clients and even agents aren't really comfortable with the idea of what qualified money is. And qualified money is money that's qualified for special tax treatment. In general, what it usually means is qualified money is pre-tax money. Qualified money is typically from a 401k or an IRA or a 457B, something like that, where the money's never been taxed yet. And so whenever money comes out of a qualified plan, it is subject to tax, taxed as ordinary income. So that's one of the important things when we think about retirement savings, the idea of qualified money that would all be subject to tax when it comes out versus non-qualified, which would have some after-tax component to it.
Gotcha. Okay. Yeah, so qualified money, I'm guessing there's got to be a lot of different rules that we probably should go over at least one time.
Right. Well, yeah, the rules and opportunities for qualified money. I mean, it gets its special tax treatment because they were trying to encourage people to save for retirement, particularly, with pre-tax money and often out of employer-sponsored plans. So, that's how they worked, was that they did get very often deduct that income from their earnings for that year and not pay tax on it. And then further, it was tax deferred. Yeah. So the growth on that money also wouldn't be taxed until they actually take the money out. Yeah. So that's one of the rules, is that it's tax deferred. Now, I mentioned taking the money out. There's some other things there. One of the big things with a qualified account is that there is a required minimum distribution date, or RMD date. And that's a date at which time you must start taking money out of your qualified plan. And again, annuities and retirement plans, qualified plans in particular, are designed to build up and distribute retirement income. And so RMDs, for example, are a way to require people to take money out before, while they're still alive, so that it does look like a retirement income.
Yep. So, we're talking about retirement, planning, retirement accounts that people have been saving for all their lives. A lot of the agents that may be watching probably have a lot of clients that are already on Medicare or about to, so they have these accounts. So what would you, I'm guessing, this has to be a pretty large amount of money that a lot of people probably have saved up. What would be like, say, the average 401k size?
Oh, yeah, that's a great point. There is a tremendous opportunity with annuities for qualified accounts in particular. I don't know what the percentage is. I believe it's probably approaching 50% of annuity sales that come from qualified money. Yeah. And it's not uncommon to see in ordinary households across America that someone might have 80 or 90% of their total retirement assets in a qualified plan. Many times people, if they worked for an employer for a very long time and they were putting money into a 401k for a long time, and it was being matched by the employer. And, we've had several really good, strong performing decades in the stock markets in recent years. So it's not uncommon for people to have a pretty sizable qualified account sitting at an employer when they're ready when they're ready to retire. Very often it can represent 90% of what they have. Now, one of the other rules, if we take back a little bit to the other question, is if people are taking money out of their qualified plan, they're required to take it out at 73. If they take it out before 59 and a half, they could also be subject to a penalty tax, to ordinary income, as we talked about earlier, but also a 10% penalty if they're under 59 and a half. Yep. And the thought process behind that is, if you're taking money out before 59 and a half, that doesn't really look like a retirement-oriented need. To build up and distribute retirement income, distribution should be at retirement age, which is as people start approaching, 65 and thereabouts. Full retirement age is often 67 now. So 59 looks a little short of that, and so it does get penalized. Mm-hmm. But the 401k accounts, as I mentioned, very many average households can have 401k accounts in the $400,000, $500,000, $600,000, $700,000 range. I think I saw something recently that, like on Fidelity, for example, the average account size for households between 59 and 64 was over 200,000. And I think Vanguard had a similar number that was close to 300,000 as the average size of the account for people in that 59 to 64 age bracket. So those are some pretty substantial accounts.
Yeah.
And so I would think for many agents out there, they may think that they don't have people that have this need. And that's America. That's, what America looks like across the board. And so if someone's got a few hundred clients, they've got to have a few people like that in their book of business, clients that are theirs. Sure. And I guess my thought is, are they getting their share of their business? If they have clients that have that kind of money, will those clients come to them for help with their annuities, or are they going to end up going to somebody else? Yeah. So it's important that they let them know that they can help them with that.
Yeah. So, lastly, I was wanting to touch base on maybe another rule that's come up lately that is starting to affect people, when they're starting to pass away, and that's inheriting IRAs. And that Secure Act, the first one that came out, back in 2020, now they've come out with the Secure Act 2.0 that's throwing kind of a little bit of a wrench into how you want to plan passing these in-qualified funds on. Do you want to talk about that for a brief moment?
Yeah, no, that's an interesting point because many qualified accounts are inherited or passed on. And the new Secure Act rules require that for most inherited IRA beneficiaries, they must take all of the money out within 10 years. Mm-hmm. It used to be that they could take it out over their lifespan, but Secure Act 2.0 has made it so that they must take it out within 10 years of the date of death from the person they inherited from. Mm-hmm. So that's a little bit different. I wouldn't say that it changes it completely, but it does change it. It's a new rule. It still doesn't make them do it all at once. 10 years is a pretty generous time to be able to spread the taxes out on that taxable event for them. But it can't be done for a lifetime anymore. It's done for 10 years. Yeah. So that's one of the big changes that we've seen with the Secure Act.
Yeah. So, and you had mentioned earlier, potentially a lot of families, 80 to 90% of their retirement funds are qualified. So, considering the Secure Act and having to worry about passing on all that qualified funds to, say children or whatnot, there's got to be a way to maybe lessen the blow on that. What would you say there?
Interesting. I'm guessing you're thinking about a Roth IRA.
Sure am.
Yeah. And so with qualified money, one of the opportunities that comes up an awful lot, and we could do a full session just on the Roth conversion. But when someone has a lot of qualified money, particularly more than they need, and they can afford to save some taxes on that money, there's a terrific opportunity for them to convert some of that money into a Roth IRA. And there can be significant advantages to that. The Roth makes that not taxable and also not subject to a required minimum distribution ever. So there's some real advantages to getting there, and there's some important steps that you'd have to take to get there, including paying taxes on that money. But there's a significant opportunity for that.
Yep. So if any of these topics that we just discussed, Tim and I have, if you want to get a hold of us, kind of dive a litl deeper into one or two of these different topics, certainly give us a call. Tim, how can they get a hold of you?
So my email address at Gordon Marketing is timl@gordonmarketing.com. And my direct phone number is 330-283-6140.
All right. And you can get a hold of me. I'm an extension 1. My email is sallison@gordonmarketing.com. And with that, we're running out of time. So make sure you subscribe to the channel and hit the notification bell so you get notified every time we put out a new video. Also, like, comment, and share. And with that, happy selling.